Hi, my name is Chris Bell, and I'm going to give you 5 reasons why you should buy Goldman Sachs stock, which is GS on the New York Stock Exchange. They're currently trading at about $225, which gives them a market cap of $85 billion. They've been in business for 149 years. They were established in 1869. The good thing about being in business for that long is that you've had multiple CEOs and people start to recognize the company for what the company is rather than the person who founded it, like Mark Zuckerberg with Facebook. A lot of the attention is focused around Mark Zuckerberg and what he's created, even though he's got thousands of employees at this point. He's growing, he's new, he's trying to find his place in the industry and in the world, and he's making money and they're doing great and everything, but there's still questions about the future. And there's not really questions about the future with Goldman Sachs. They've just been in business for so long. They've been through all kinds of ups and downs in the economy and in the world with wars and depression and racism and revolutions and all kinds of different things that have gone on in the world, and they've made it through it all. The second reason is the balance sheet, and it's the balance sheet in comparison to the market capitalization. The company right now, if you liquidated it, you could have $75 billion. You sell all the assets, you pay off all the liabilities, just like if you sold all of your stuff at your house, you had a major yard sale, I call it your naked value. If you got rid of your house, got rid of your car, got rid of everything, got rid of the clothes on your back, and you sold everything and you're naked in the street, how much do you have? That's your equity balance sheet value. And that's what I like to look at with the companies, because when you look at the company and you liquidate them completely, you see exactly what they have. You could say that you have a house that's worth $300,000, but is the loan on the house 325? Are you completely upside down, or is the loan 100? So the liabilities make a huge difference against the assets that the company has. And right now, my feeling is that their balance sheet is looking great. They have $75 billion that you could liquidate for. So what happens is I could buy the entire company right now. If I bought every single share available on the New York Stock Exchange for $225, it would cost me $85 billion to buy it. So let's say I do that. I take $85 billion out of my pocket, I buy the entire company, and I decide, nah, I don't want to do this anymore. So I close all the doors, I fire the employees, I sell all of the property, I sell all of their assets, I pay off all of their liabilities. I end up with 75. So technically I lost 10 by doing that. I bought the entire thing for 85 and I sold everything off for 75. So let's take a look at the income statement next. The third reason is the income statement. Goldman Sachs is averaging $6 billion per year over the last 4 years in net income, which gets added to the balance sheet. We already said that the balance sheet is at $75 billion liquidation value. And if you add 6 and then add 6, you end up at $87 billion. So I could buy the entire company today and run it for 2 years. So I buy it for 85, I run it for 2 years, I end up with 87. I sell everything off and close the doors. I don't even have to find a buyer for it. I just sell everything off and close the doors, and I made $2 billion, and I can do whatever I want with that money at that point. So somebody with that much money should buy the entire company of Goldman Sachs, because the stock price has gone down to a level where it's a very, very attractive price. For someone like Warren Buffett, it's a value investment play. So that's where Warren Buffett jumps in and buys something, because he knows that he could just liquidate the company even if the income started going down. But in this case, Goldman Sachs is still making a lot of income. They're making $6 billion per year. So if you take that and you multiply it times 5, you have $30 billion plus the 75 that's on the equity on the balance sheet, and you have $105 billion. So if the share price stays at 225 and the equity goes up to 105 in 5 years, then you could buy the entire company at $225 for $85 billion and turn around and close the doors tomorrow and make $20 billion, which is just, it's like buying a foreclosure at nothing, just because, and it's still sitting there and the house is in great shape and you can buy it for 50 and sell it for 100 the next day. That's the position that they're in. So right now, based on the current income, they could, in about 2 years, you could take that 75 billion in equity on the balance sheet and turn it into 87 billion, which is more than the market cap right now, which is just unheard of. There's probably 10 to 15 stocks in this New York Stock Exchange that can do that. One of them is Toyota Motors, one of them is Citigroup, and the other one is Goldman Sachs. So I find those very, very attractive. The fourth reason is the cash flow statement. The balance sheet looks good, the income is good, the money's coming in, but the cash flow statement tells what are they doing with the money. So there's a few things that I like to look at on the cash flow statement, which are at the bottom, and it's under financing activities. So there's three different things. Number one is the dividend, and they're giving about $1.7 billion worth of a dividend every single year over the last 4 years. It's very easy to look at on Yahoo Finance or on otcmarkets.com. It shows you the financial statements. You click on cash flow and you go down to the bottom and you'll see dividends, and they're giving away $1.7 billion per year, which is about $3.20 per share that you own, or it's about 1.5% or so, 1.4%, depending on the price, percent per year that you would be getting. So that's a great start. The second thing that I like to look at is the buybacks. And when a company is doing really well and they're making a lot of money, they like to buy back some of their shares, especially if they think that the price is attractive. And I could see Goldman saying that their price is attractive right now because they are buying back their shares, and they're buying them back at about $3.7 billion per year over the last 4 years. The third thing that I look at on the cash flow statement is the net borrowings. And unfortunately, this is not my favorite thing about Goldman Sachs, but it's not too bad. They're borrowing upwards of $17 billion per year over the last 4 years. They've borrowed over 60, almost $70 billion. But the good thing about that is that when you look at the balance sheet, the borrowings directly go to the balance sheet and you have to subtract them from the assets. So all of the assets that they have right now, and then you subtract the liabilities, they're at 75 billion. So even though they've borrowed all of that money, it's not like it's invisible. It goes directly onto the balance sheet as a liability. So it's not like the dividend is harder to find and the buybacks are harder to find because you're using cash, but it doesn't go onto the balance sheet. You don't necessarily see it as easily as you can see the borrowing. So when they're borrowing money, it goes onto the balance sheet, and you have to do that calculation of assets minus liabilities, because if they really had to sell everything off, they'd sell their property, they'd sell all of their computer systems, they'd sell everything that they have, all of their cash would end up back, and they would liquidate, and they'd have $75 billion. They wouldn't get that net income anymore. So a good time to liquidate is when you lose money every year for 5 years in a row, and that 75 turns into 70 and then 65, and you might decide to just liquidate the company or sell it off for the assets to another company. But right now, Goldman is looking great. The fifth and final reason to buy Goldman Sachs stock is the goodwill and intangible assets. And I typically say that that's a bad thing because I subtract it off of the equity level. And right now there's about $4 billion of goodwill and intangible assets on Goldman Sachs' balance sheet. And what happens is you take the 75 number and you subtract the goodwill and intangibles, which is 4, and it brings you down to 71, because the goodwill and intangible assets, if you decided to liquidate the company like I was saying earlier, you would not be able to sell the goodwill and intangible assets. The goodwill comes onto the balance sheet when Goldman Sachs acquires another company for more than their book value. So if they find a company that has a book value of 75 billion in equity and they buy it for 80, then they take the 5 additional and put it onto their balance sheet as an asset, but they don't put any liability there. So it increases their equity level by that amount just because they paid more for a company than it's technically that it can liquidate for. So I don't really like to use that number, because if you really had to liquidate a company, you wouldn't get that money. You also can't go find the goodwill in the warehouse and turn around and sell it in the open market because it's not there. I would assume that, if a company is making $1 billion in net income per year and they pay an extra $5 billion over book value for it, then it's going to take 5 years to make that money in income and put it onto the balance sheet because they just acquired that company. So they're going to make that money back, but let it flow onto the balance sheet as it comes in. If it comes in and when it comes in, it will get there. So there's no reason to put it there in the beginning. So I subtract it right away. So in this case, Goldman Sachs has $75 billion in equity, minus the 4 brings them down to 71. They're making 6 per year. So if you add 12, the 2 years worth into that number, then you would go from 71 up to 83. So you're still $2 billion shy of the 85 number right now. So in the 3rd year, you would go well over that. In the 4th and 5th year, you'd go well over that. Like I said before, if you take 5 years at $6 billion per year, you add 30 to the 71, and you end up at 101. And the market cap is currently at 85. So the market cap would have to go up 15%. So add 15% to the 225 number, and you end up at, 260, maybe even 270, one of the highest levels that Goldman's been at for a long time. And I think that they're well worth that number, even if you look at the chart, because a lot of chartists and chart experts will look at it and try to think about the psychology of when the chart is going to go up and when it's going to go down. But if you really look at the equity level and the fundamentals of the balance sheet, the income statement and the cash flow statement, you can see where that cash is coming from and how quick it will get there. And this is a great buy right now. Goldman Sachs is. You can buy the company for 75, hold it for 5 years. You'll turn into $101 billion in liquidation value, and the company you can buy right now for 85. So if you bought something for $85 billion or even $85, and in 5 years you could sell it for $101 billion, you would just make a whole bunch of money. So I would recommend buying Goldman Sachs. I would buy it for $250 a share right now. It's so attractive. Thank you.